Okay, this video is for Unit 4, Activity 2, Transactions 4 and 5. We'll be doing Transactions 4 and 5 together because they both have to do with bad debt and making allocations for bad debt. So this falls under the allocation style of adjustment. So first, what is bad debt? Bad debt is simply the amount in your accounts payable accounts receivable, the money that you're going to receive from clients or customers that you don't actually think you're going to get. You're not going to be able to collect it. They're not going to pay for one reason or another. So you've made these sales and you've been counting on this money coming in. You've had it recorded in your accounts receivable. And you look around and you go, you know what? I don't think they're going to pay. And so instead of keeping that on the books, you have to get it off the books so that you're not counting on getting money that you're not actually going to ever receive. All right, so you're kind of cutting your losses and moving on. So this is how you do that. This is how you enter an adjustment like that into your journal. So the first one is transaction number 4. On May 28th, the senior accountant informs you that approximately 1% of all sales on account this month will likely not be collected. On May 31st, sales on account amounted to $15,547. All right, so for this one, what we're going to do is we're going to figure out how much of the money that is owed to us, or the amount that's in our accounts receivable, is not going to be collected, or we're not going to make an effort to collect, or we don't think we're going to get. So in this case, our total sales, or their total accounts receivable, is $15,547. And to figure out what percentage of that we're not planning on getting, or we're not planning on collecting, all we have to do is multiply that number, 15,547, by the percentage that we don't think we're going to get, which in this case is 1%. So again, I can pull up my calculator. So we've got our total sales, 15,547, and we're just going to multiply that by 1%, which is 0.01. And so that's going to give us the amount of our sales that we just don't think we're going to get back. We don't think we're going to collect. So $155.47. So really not too bad, at least in this scenario. Obviously, you want to get all the money that's owed to you, but if you don't, 1% is probably not too bad. All right, and so now the question is, we need to put this in our journal, but how? And what accounts does it affect? So our first account, our debit account in this scenario in transaction 4, is going to be our bad debt expense. And this, like many of the other accounts I've mentioned so far in this activity, are accounts that you wouldn't be familiar with yet. You are familiar with expense accounts, but you are not necessarily familiar with bad debt expense. So it's just another type of expense account, and it behaves the same way as the other expense accounts. And so our debit for that one, since we're adding to the expense account, is going to be $155.47, which is 1% of our sales. The sales that we don't think we're going to be able to collect. Good. So that is our debit. And so now we just have to do our credit. And so the question is, again, what account is going to be affected by this? And this is another new one to you guys, which is allowance for doubtful. All right, so accounts that we doubt we're going to get our money from. And so this one is a little tricky. This is what is known as a contra account. And it is kept under the assets section. So the thing that's tricky about it is that its debits and credits are opposite of what usual assets debits and credits do. So for example, if you think about the bank account in your assets, if you are adding to your bank account, you're going to debit it. If you're taking away from your bank account, you're going to credit it. And so this one, the allowance for doubtful accounts, even though it's underneath the asset part of the balance sheet, its debits and credits act contrary or contra to the way that most asset accounts work. And the reason for that is that it's going to be linked to our accounts receivable account. And we keep it near the accounts receivable account so we can sort of comment on the accounts receivable. So your accountant can quickly look at your accounts receivable and go, okay, in our accounts receivable, we have $1,000. So we think that we're going to get $1,000 from our clients at some point in the future. And the reason that you keep the allowance for doubtful accounts account close by is that you want to see how much of that accounts receivable is real and how much of it is, I don't think we're going to get that back. Right. So you might have $100 in your allowance for doubtful accounts. So in that case, when you're looking at your $1,000 accounts receivable, and then you see the $100 in the allowance for doubtful accounts, you realize, okay, accounts receivable is really about $900. So that's the purpose of this new account, the allowance for doubtful accounts. It basically comments on the accounts receivable and lets you know how much you can really expect. All right. So even though we're adding an amount or increasing the amount of the allowance for doubtful accounts, and even though it's an asset account, this is going to be a credit, right? And it's going to be for the same amount as the bad debt expense account. So contra accounts, as I say, they do the opposite of whatever section they're in, whether that's liability or asset or owner's equity. So that's one example of contrary accounts. There are a few others, but that's one of them. All right, and then we just need to do our description of what's going on in this transaction. So we're just going to say something along the lines of to record allowance for uncollectible right. So that is the first style of adjustments for bad debt or debt that we don't think we're going to get back or collect. The second style is number 5, transaction number 5. So let's go ahead and take a look at that. On December 31st, the account manager decides that all uncollectible accounts should be written off and removed from the accounts receivable ledger. Currently, the value of these accounts is $1,750. Okay, so in this one, it's a little bit different. The accounting manager doesn't want to make any estimates about what percentage they think they're not going to get back or anything like that. They've decided that everything that hasn't been collected yet that's on the accounts receivable ledger is not going to be collected. We're not going to be able to track that down. We're not going to be able to get it back. So in that case, we're just going to completely get rid of it off of our books. So in this case, our debit is going to be the allowance for doubtful accounts. And that is going to be for the total amount of the accounts receivable, which we were told is $1,750. Okay, and you'll notice that we're doing this as a debit, and in the previous transaction, we did it as a credit in the allowance for doubtful accounts. So that's because in this one, we are decreasing the allowance for doubtful accounts. We're taking this off the books and we're getting rid of it. So we're no longer making an allowance for it because we're also going to be getting rid of it out of our accounts receivable. And so that's our next move here, is the accounts receivable. We're going to be crediting that for 1,750. Remember that an accounts receivable account is just a regular asset account. So a credit affects it by decreasing the amount in the accounts receivable. Right. So basically, this method of dealing with bad debt kind of erases it completely off the books and makes it so that it basically never happened. This one, from what I understand, isn't used as commonly in the real world, just because it makes it so the transactions that led to those amounts never happened. So, for example, the sales team makes a $5,000 sale, and then that's recorded in the accounts receivable because the client bought it on credit. Well, if that client never pays, and you go back and you just use this bad debt write-off style, the one that we just did, the transaction 5, then the sales team doesn't really get credit for their sale because it's kind of written out of the books. And that's not really fair to them because, they made the sale and it's really not their job to track down the money afterwards and to get paid and collected and all of those sorts of things. So a lot of times this write-off technique isn't necessarily used. It's more common that they do the first technique with the bad debt expense, at least from what I understand. All right. So that is transaction 4 and 5, bad debt adjustments. And as I said, that's the allocation style of adjustment, if you're interested. All right, so our next video will be for transaction number 6.